Zero down does not mean zero out of pocket. If I qualify for a zero down loan, that does not mean I need $0 to buy the house. Not necessarily anyway. Zero down means the loan program may not require a down payment. It does not automatically erase every other cost in the transaction. You may still have closing costs, prepaid homeowners insurance, prepaid interest, initial escrow deposits, and appraisal, inspections, earnest money, or other costs depending on the transaction itself. Now, seller concessions, builder incentives, lender credits, and other approved sources may reduce that what you have to potentially bring. In some transactions, though, the buyer may bring very little to closing. In other transactions, using the same loan program, the buyer may need several $1,000s. That is why zero down and zero out of pocket are not the same statement. Do not plan around the slogan. Plan around the actual loan estimate and the complete structure of your entire deal. And one of the biggest reasons the final number surprises buyers is not always the lender fees. It's the money being collected for costs that have not even happened yet. Why taxes and insurance surprise buyers? Why am I paying taxes and insurance at closing if I have not even owned the house yet? Because some of the money collected at closing is not a fee. It is money being set aside for future obligations. Depending on the loan and the closing date, you may need to pay the first year of homeowner's insurance. You may also have to fund an escrow account, so money is available when property tax and insurance bills come due. There may also be prepaid interest, covering the period between closing day and the beginning of your first full mortgage payment cycle. That is why two buyers purchasing homes at the same price range can have very different cash to close numbers. They may have different closing dates, different tax amounts, different insurance premiums, different loan structures, or different escrow requirements entirely. These are called prepaids because you are paying or setting aside money before the bill is due. They increase cash to close, but they are not all lender, profit, or random fees. And once buyers understand where those costs come from, the next question is usually, do I actually have to pay all of this myself? Not always. Can the seller pay my closing costs? Can the seller actually help you pay your closing costs? Potentially, yes. This is generally called a seller concession or a seller contribution, depending on the loan program, the purchase price, the appraisal, the contract, and the allowed contribution limits. The seller may be able to cover and help cover certain buyer costs. This may include allowing closing costs, like prepaid expenses or sometimes a rate buydown. This can reduce the amount of cash a buyer needs to bring at closing. But seller concessions are not automatic. They have to be negotiated. The property still has to support the price, and the contribution has to comply with loan guidelines. This is why the offer is not just about the purchase price. A slightly higher offer with useful concessions may put the buyer in a better position than a lower price with no help at closing. But the full math has to be compared. This is also why I tell buyers, do not wait until after you find the house to talk about cash to close. The financing and the offer strategy need to work together. If you want help thinking through your numbers, there's a link in the description. As always, no pressure, just clarity. Now, the seller can help and it can be very powerful, but new construction buyers often see something that looks even better, a large builder incentive. And that is where you need to slow down and compare carefully. Are builder incentives really free money? The builder is sometimes, many times, offering up to $20,000 when all things are considered. Now, is that basically free money? No, it may be very valuable and it may save you a substantial amount of money, but it is not automatically free money. Builder incentives come with conditions. You may need to use the builder's preferred lender, the builder's title company, a particular loan structure, or a specific interest rate offer. The incentive may be used for closing costs, a temporary buydown, a permanent rate buydown, upgrades, or a combination of these different items. The real question is not how large is the incentive. The real question is, what's the final price? What's the interest rate? What are the fees? What is my monthly payment? And how much cash do I bring? And How much money do I still have afterward? A $20,000 incentive attached to a higher price tag or less competitive financing may not be better than a smaller incentive with a stronger overall structure. Never evaluate the credit by itself. Compare the entire deal. Now let's talk about money that you may have already paid, because some buyers often think their earnest money is an extra cost on top of everything else, and usually that is not how it works. What happens to my earnest money? Do I lose the earnest money when I close? Your earnest money is generally credited towards the transaction at closing, and it is not normally a separate charge added on top of your final cash to close. For example, your final transaction requires $10,000 from you, and you already deposited $3,000 in documented earnest money. That deposit may appear as a credit, reducing the remaining amount that you need to bring on the day of closing. But there are two important issues. First is the lender needs to verify and source where the money came from. This is huge. Second, what happens if the transaction does not close? That depends on the contract and the circumstances. That is a legal and contractual question, not just a mortgage question. So earnest money may count towards what you need to bring for closing, but you still need to understand how much are you depositing, when is it due, how is it documented and sourced, and under what conditions it may or may not be refundable. Now here's where buyers mix up the two completely different buckets of money. Money needed to close and money the lender may want to see after closing. Reserves are not cash to close. Are my reserves part of my cash to close? No, they are related, but they serve two very different purposes. Cash to close is money used to complete the purchase. Reserves are assets remaining after closing. Think of reserves as financial breathing room depending on the loan, the property, the number of homes owned, the automated underwriting result, and the borrower's full profile. Reserves may or may not be required. When reserves are required, they are often measured in months of housing payments. For example, if the total monthly housing payment is $2,000, 2 months of reserves would generally mean $4,000 remaining in acceptable assets after closing. You do not hand that money to the title company. It stays available to you, but the lender may need to verify that it exists and it is in place. So cash to close gets you through the door. Reserves help show that you can remain stable after you walk through it. And this brings up one of the biggest mistakes I see buyers make. They technically have enough to close, but only because they are willing to empty almost everything. Should I use all of my savings to buy? If I have enough money to complete the purchase, should I use all of it? Usually, that's not the question I want you asking. The better question is, what position am I the day after closing? Because the house does not stop costing money when you get the keys. You may still need money for moving expenses, furniture, appliances, repairs, utility deposits, maintenance, a higher than expected bill, a job interruption, or a family emergency. A buyer can qualify, a buyer can close, and that same buyer can still be financially fragile afterwards. That is not the goal. Sometimes using more cash makes sense. It may reduce the payment. It may eliminate a mortgage insurance. It may improve the loan structure, but draining your savings just to say you bought the home can turn home ownership into immediate financial stress. The goal is not merely to have enough money to close. The goal is to have enough money to comfortably own the home after closing. And this is why choosing the loan with the smallest down payment does not automatically mean you have chosen the best structure. Which loan requires the least cash? In other words, which loan program will require the least money from me? That may be useful to know, but it's not always the right first question. A loan program is only one piece of the structure. You also have to compare the interest rate, mortgage insurance, funding fees or guaranteed fees, closing costs, seller concessions, builder incentives, monthly payment, qualification guidelines, and how much cash you retain after closing. A zero down option may preserve the most cash, but creates a different payment. A larger down payment may reduce that payment, but leave you with less liquidity. A conventional loan may work better for one buyer, FHA may work better for another. VA or USDA may create the strongest structure for someone who qualifies. The correct answer is not based only on which loan requires the least cash today, it's based on which complete structure puts the buyer in the strongest position. And that takes us to the final question. It is the question I think every buyer should ask before deciding how much money to use. How much money should I have left over after closing? So how much money should I still have after I close on my home? There is no universal number here that works for every single person, but 0 is usually not the target. The right amount depends on your monthly expenses, the condition of the home, your job stability, your family size, your other debts, whether you own additional properties, and how comfortable you are with financial risk. For one buyer, a few months of total living expenses may create enough breathing room. Another buyer may need considerably more because income is variable, the house needs repairs, or a major life change is coming. So before you decide how much to put down, ask, what is my total cash to close? What money will remain? What repairs or moving costs are coming next? What happens if my income changes? And will I still feel comfortable after I become the owner? Because buying the house is not the finish line. Living in it comfortably is the actual goal. Here's the simplest way to bring all 10 questions together. Don't not only ask, what is my minimum down payment? Ask, what is my total cash to close? What costs are included? What credits are available? What have I already deposited? What reserves may be required? And what remains after everything is paid? Because the same buyer can purchase the same house using 2 different structures and end up in 2 completely different financial positions. One structure may minimize cash today but create a higher payment overall, and another may require more money up front but reduce the overall payment, and another may preserve cash through concessions while keeping enough reserves for a life after closing. There is no magic answer for every buyer. There is only the complete picture. So if you are planning to buy a home, do not stop at the down payment. Understand the closing costs, the prepaids, the credits, the earnest money, the reserves, the monthly payment, and the money you still have afterwards. If you want help thinking through your entire situation, there is a link in the description. And as always, no pressure, just clarity. And if this video helped, subscribe to the channel. I break down real estate and financing so you can make clear, confident decisions before you buy, sell, invest, or finance a home.